When silver hit $110 per ounce in late January, something very interesting happened just days later. The price crashed 50%. Treasury Secretary Scott Bessent blamed Chinese speculators, and the CME changed one simple rule that triggered the entire collapse. Coincidence? Maybe. But today I'm going to show you the evidence, and you can decide for yourself. It's Sunday, February 15th, New York time. Comment your date and location below so I can see where you're watching from around the world. If you find this analysis valuable, please subscribe and comment George Williams, because it genuinely helps this channel reach more people who need to see this information. So let's talk about what actually happened here. Silver had been on an absolute tear, climbing 162% over the past year. The fundamentals were screaming bullish. We had a supply deficit for the sixth consecutive year. Industrial demand from solar panels, electric vehicles, and AI data centers was consuming more silver than the world was producing. Investment demand was surging as people looked for alternatives to gold, which had rocketed to $5,000 per ounce. Everything was pointing toward higher prices, and the market responded. Silver broke through $100 for the first time in history, and by late January, it had touched $110 per ounce. Investors were euphoric. This was the breakout everyone had been waiting for. Then, right at that moment, the Chicago Mercantile Exchange announced they were raising margin requirements on silver futures contracts from 11% to 15%. Now, on the surface, that might sound like a reasonable risk management decision. But here's what's interesting about the timing. They didn't raise margins when silver was at $60. They didn't raise them at $70 or $80 or $90. They raised them at the exact peak, right after silver hit its all-time high. And what happened next was entirely predictable. Traders who were using leverage to control large positions suddenly had to come up with more cash to maintain those positions. Many couldn't, so they were forced to sell. And when everyone's selling at the same time, you get what's called a forced liquidation cascade. Prices plummet, stop losses get triggered, more people are forced to sell, and the whole thing feeds on itself. Within days, silver had crashed from $110 down to where we are now, around $83. That's a 50% decline in a matter of weeks. Treasury Secretary Scott Bessent came out publicly and said the volatility was driven by speculative activity, particularly from Chinese traders who had piled into silver with massive amounts of leverage. And you know what? He's not wrong. There absolutely was excessive speculation. Chinese traders were documented as being heavily involved in the silver market with significant leverage. That part is true. But here's the question I want you to think about. If excessive speculation was the problem, why did they wait until the exact peak to address it? Market regulators have access to positioning data. They can see when leverage is building up. If they were genuinely concerned about market stability, wouldn't they have acted earlier, when silver was at $80 or $90, before it became a crisis? The timing raises some very legitimate questions. Now, before we go any further, let me acknowledge the counter-argument here, because it's important to be balanced about this. The CME's job is to manage risk and prevent markets from becoming unstable. When they see excessive leverage building up in any commodity, they have a responsibility to increase margin requirements to protect the integrity of the market. That's literally what they're supposed to do. And there's a legitimate argument that if they had let this speculative bubble continue, the eventual crash could have been even worse. So I want to be very clear. I'm not saying definitively that this was manipulation. What I'm saying is that the timing and the circumstances create enough questions that we need to examine this more closely. Let's talk about history for a second, because this isn't the first time something like this has happened in the silver market. Back in 1980, the Hunt brothers tried to corner the silver market. Silver went from around $6 per ounce to $50 in just a few months. And what happened? The COMEX, which is the Commodities Exchange, changed the rules. They implemented something called Silver Rule 7, which dramatically restricted new purchases and essentially forced liquidation. The silver market collapsed, and the Hunt brothers went bankrupt. Now, you can argue that was necessary to prevent market manipulation by the Hunts, but you can also see the pattern. When silver gets too high, the rules change, and the price gets hammered. More recently, we've seen actual settlements and admissions related to silver market manipulation. JP Morgan paid nearly $1 billion in fines for spoofing and manipulating precious metals markets, including silver. That's not a conspiracy theory, that's documented fact. Traders at major banks were placing fake orders to move prices, and then canceling those orders. The CFTC, which is the Commodity Futures Trading Commission, has investigated silver market manipulation multiple times. So we know, as a matter of historical record, that manipulation in the silver market has occurred. The question is whether it's still occurring, and whether what we just witnessed was part of that pattern. Think about who benefits from lower silver prices. Large banks hold significant short positions in silver futures. When prices fall, those short positions become profitable. Industrial users who need physical silver benefit from lower prices because it reduces their input costs. And there's an argument, though more subtle, that the US government has an interest in keeping precious metals prices under control because surging gold and silver prices can undermine confidence in fiat currency. When people see silver going parabolic, it makes them question the value of their dollars. Now, I'm not saying the government directly manipulates markets, but there are certainly institutional interests aligned with keeping precious metals prices from getting out of control. Let's look at the actual fundamentals right now because this is where things get really interesting. The silver market is in a structural supply deficit of approximately 67 million ounces expected for 2026. That's the sixth consecutive year of deficit. Total global demand is running around 1.2 billion ounces, while supply including mining and recycling is only about 1.03 billion ounces. That's a deficit of 160 to 200 million ounces. Solar photovoltaic manufacturers are consuming over 25% of the entire annual global silver supply. Electric vehicle production drove silver demand up an estimated 20% last year. AI data centers, advanced semiconductors, consumer electronics, all of these are eating up physical silver. This is real industrial demand that doesn't go away just because the price fell. And here's the kicker. Physical investment in silver is forecast to rise by 20% in 2026 to reach 227 million ounces. People are buying the physical metal, so we have this disconnect. The paper price on the futures market crashed 50%, but the physical fundamentals haven't changed at all. In fact, they've gotten stronger. The deficit is still there. The industrial demand is still growing. And this is where the manipulation argument becomes compelling, because futures markets can be manipulated through leverage and margin changes and concentrated short positions. But you can't manipulate physical supply. You can't create silver out of thin air. If the physical shortage continues, eventually that has to show up in the price, regardless of what games are being played in the paper markets. Now let me present the alternative view, because I want you to have both sides of this. It's entirely possible that this was just a natural market correction. Silver had gone up 162% in a year. That's a massive move. When you get that kind of parabolic rise driven by speculation and leverage, corrections are normal and healthy. Markets don't go straight up forever. The fact that Chinese traders were heavily leveraged is documented. The CME increasing margins could have been a legitimate response to excessive risk in the system. And sometimes, when you look for patterns and manipulation, you're really just seeing the normal chaotic behavior of markets. Not everything is a conspiracy. Sometimes a correction is just a correction. But here's where I come back to the timing question. If this was purely about risk management, the CME had months to act as silver climbed from $60 to $70 to $80 to $90. They waited until 110, right at the peak, and then they acted. That's either the most perfectly timed risk management decision in history or something else was going on. You decide which explanation makes more sense to you. So what does this mean for where silver goes from here? If we're looking at a manipulated market, then prices could remain suppressed in the short term while the physical shortage continues to build. Eventually, something breaks. Either COMEX inventories get depleted because people start demanding physical delivery, or industrial users can't get enough supply, or investment demand overwhelms the available physical metal. When that happens, the paper manipulation breaks, and prices can move violently higher because the physical fundamentals override everything else. Think of it like holding a beach ball underwater. You can do it for a while, but it takes increasing effort, and when you finally let go, that ball explodes to the surface. If we're looking at a natural market correction, then this is probably a healthy reset before the bull market continues. The fundamentals of supply deficit and industrial demand are still intact. Silver found support around the $80 to $85 level, which suggests the market is stabilizing. From here, we could see a consolidation period where silver trades in a range, building a base, before eventually making another run higher. In the short term, I expect continued volatility. We're probably looking at a range between $75 and $90 as the market digests what just happened and tries to find equilibrium. Medium term, if the supply deficit continues and industrial demand holds up, I think we're likely to see silver test the $100 level again, probably in the second half of 2026. Long term, if these fundamentals play out and the physical shortage intensifies, we could be looking at silver in the $150 to $200 range over the next couple of years. But that assumes the physical market eventually asserts itself over the paper market. Here's what you need to watch to figure out which scenario is playing out. First, look at COMEX inventory levels. If inventories start declining rapidly, that's a sign that people are taking physical delivery and the paper manipulation is weakening. Second, watch physical premiums. If the premium you have to pay to buy actual coins and bars over the spot price starts widening significantly, that tells you there's a shortage of physical metal. Third, monitor commercial positioning. The Commitment of Traders reports show you how banks and commercial traders are positioned. If their short positions start declining, that could indicate they're covering and the manipulation is ending. Fourth, pay attention to any delivery failures or delays on the COMEX. If people who own futures contracts demand physical delivery and the exchange can't provide it, that's a game-over moment for price suppression. So what should you actually do with this information? If you believe there's manipulation happening, the logical response is to focus on owning physical silver rather than paper contracts. If prices are being artificially suppressed, then physical metal at lower prices is actually an opportunity. But you need to be smart about allocation. Financial advisors typically recommend no more than 10 to 15% of your portfolio in silver, with total precious metals exposure capped at 20%. Don't bet everything on one thesis, no matter how compelling it seems. And for the love of everything, do not use leverage. If this market taught us anything in the past few weeks, it's that leverage can destroy you in a manipulated market because they can move prices against you faster than you can react. The difference between owning physical and owning paper is crucial here. If you own physical coins or bars, nobody can margin call you. Nobody can force you to sell. You're not exposed to counterparty risk. You actually own the metal. If you own futures contracts or even some ETFs, you're exposed to the paper market dynamics we've been discussing. There's a reason why physical premiums have remained relatively stable even as the paper price crashed. People who understand these markets are buying physical. Look, I'm not here to tell you that there's definitely manipulation happening in the silver market. What I'm here to do is present you with the evidence and the questions that evidence raises. The timing of the margin increase was suspicious. The historical precedent of rule changes crushing silver rallies is documented. The existence of past manipulation and spoofing in this exact market is proven. The disconnect between paper prices and physical fundamentals is real. But I also acknowledge that exchanges have legitimate reasons to manage risk, and not every market move is the result of manipulation. Sometimes markets just correct. What I want you to take away from this is simple. Do your own research. Question official narratives, but also question alternative narratives. Look at the evidence yourself. Don't blindly accept what anyone tells you, including me. This isn't about conspiracy theories or paranoia. This is about asking legitimate questions when the circumstances warrant it. The silver market has a long history of unusual price movements and documented manipulation. Given that history, it's entirely reasonable to examine what just happened with a critical eye. If you found this analysis valuable, please hit that subscribe button right now and drop a comment saying George Williams, so I know you're paying attention, and so this channel can reach more people who need to see this information. The truth is out there, but you have to be willing to look for it. Stay informed, stay rational, and I'll see you in the next